Hi, I'm Mark Jewell, co-founder of the Efficiency Sales Professional Institute in San Francisco, California. Here today to talk with you about the financial analysis of energy efficiency projects, intermediate. This is the second of 3 modules that we have on this topic: beginner, intermediate, and advanced. First, let's have a quick review of the fundamentals. Most people focus on the money when they talk about an expense-reducing capital project. But as we spoke about in the fundamental section, otherwise known as the beginner section of financial analysis, you really need to look beyond the utility cost savings if you're going to make a transparent and compelling case for an expense-reducing capital project. You'll remember that we talked about 3 distinct categories of benefits. Utility cost financial benefits, these are the most obvious ones. The utility savings that you'll see on the bill, utility rebates, utility incentives. The non-utility cost financial benefits, these are the things that are in a segment or industry specific, things like increased milk production in an agricultural dairy barn that puts in LED lights instead of fluorescent, or increased productivity under more efficient lighting or in a more thermally comfortable environment. And then, of course, there are non-financial benefits, things like getting an ENERGY STAR label or getting LEED certification. And interestingly enough, though, if you look at the empirical evidence, you'll find many correlations, statistically significant positive correlations between having a label like that, maybe an ENERGY STAR label, on a building, and higher rental income, less vacancy, and higher sales price per square foot. So I remind you to consider the non-utility cost financial benefits as you assemble the financial analysis, realizing that in some cases the non-financial benefits leak back into that second bucket. Okay? Recall also that most decisions are made emotionally and then justified financially. So the watchword here is, in fact, if I had a t-shirt company, I think one of the first shirts I'd manufacture is, you have to replace myths with math and motivation. Now we're going to talk about the math in an intermediate fashion in today's class. Still, remember, you get rid of the myths and objections, you also have to provide motivation, otherwise the math may fall on deaf ears. Now, what is the ideal financial summary? Many of you were surprised to hear it's just 1 page. And why is it just 1 page? People don't have any tolerance for ambiguity. They're willing to make decisions in the presence of imperfect information, but if you give them something that's 52 columns wide in an Excel spreadsheet, it's going to be difficult to get their attention and present a clear message as to why they should do what you're proposing that they do. What does transparent and compelling mean in the context of a financial analysis? Well, for one thing, the sheet, ideally that single piece of paper, should show all the inflows and outflows from the investment. That you should be using an appropriate discount rate. What does that mean? Well, we'll talk about discount rate, otherwise known as hurdle rate, in a little bit. You have to use a credible inflation rate. Don't be one of those people that falls into the trap of trying to make the returns look more tantalizing by exaggerating the projected rate of inflation. And by the way, as I said before in the fundamentals module, if you're using an energy inflation rate that's assumed to be the same as general purchase price inflation, the higher the inflation rate goes, the higher the discount rate has to go to compensate the investor for that additional inflation. We're talking nominal discount rates now. And as a result, you're going to have the same present value, whether you used a 1% inflation rate or a 10% inflation rate. More on that later. Proper financial metrics as opposed to popular financial metrics. And I'll review the popular ones and then we'll go right into the proper ones in this module. And finally, just make sure it's on 1 page. Okay? It takes a lot of discipline, a lot of focus, and when you do that, you will be rewarded handsomely in terms of increased management attention and increased project approvals. And by the way, probably a shorter sales cycle as well. So let's talk about the topics covered in the fundamentals module. We talked about framing increased efficiency with business acumen, with some sensibility of what segment or industry you're speaking with, and also what role you're addressing. Chief Sustainability Officer, Chief Financial Officer, Chief Executive Officer, or maybe just the Chief Engineer. We talked about the importance of knowing and using the language of business, the financial statements, the marginal and effective tax rates, all those things. We talked about focusing on energy efficiency's impact on the P&L in areas more than just the utility line item. And we also talked about navigating capital budgeting. So this is a sample 1-page financial analysis. You'll see in the upper left-hand corner the discount rate, and that sort of thing, the inflation rates, of course the finance and reinvestment rates. You also see that it's a 10-year timeline. Now people say, well, how many years should your financial analysis extend? And I say 10. And they say, why 10? And I say that's the number of columns that fits on an 8.5 by 11 sheet of paper placed in landscape mode. If you want to go legal, it's 12. If you want to go ledger, it's 15. More seriously, honestly, you should be doing the financial analysis to the term period that makes sense in light of the holding period expectations of your investor for the property into which this equipment is going to be installed, and also the anticipated life of the equipment. Now, that doesn't mean that you shouldn't do a 10-year analysis for equipment that's meant to last for 5 years. For example, an energy efficient lighting retrofit, you could certainly populate year 6 with a relamping or even a reballasting if that's appropriate, and have the analysis run 10 years if the organization is on a trajectory now toward energy efficiency and is likely to relamp with the same more efficient equipment that you're putting in today, or even greater efficiency equipment. The other thing too is you can certainly take a look at lesser holding periods using a sheet like this. For example, you'll see at the bottom of the sheet a ribbon that talks about what those metrics are, everything from simple payback period right through to SIR, which is savings to investment ratio, and those metrics are recalculated every year for each of the next 10 years. So if you hand this to a decision maker and he or she says, well, we're just going to hold this building for another 4 years, give me the visibility of how financially attractive it's going to be within that period of time, no problem. Slide your finger over to year 4 or year 5 or year 7, whatever they say, and that gives you the metrics for what you're going to get from date 0, which is today, up to that intended holding period. Okay? All right, let's move on. Some of the other topics we talked about in the fundamentals module of the fundamentals, intermediate, and advanced trilogy were on this slide. Selecting the proper metrics and templates between mutually independent versus mutually exclusive, I should say mutually exclusive versus mutually non-exclusive, also called independent investments. We talked about the shortcomings of simple payback period, and we'll review those today because it's key. And we also talked about the shortcomings of return on investment. Okay. We also talked about understanding before tax and after tax views of financial returns, how to maximize incentives and rebates, and I gave you a recommendation that if you're not thoroughly comfortable with Microsoft Excel, which of course is the lingua franca of the energy efficiency financial analysis business, you got to get comfortable with Excel. And there are a couple of ways to do that, and I suggested lynda.com, Lynda.com, as a not necessarily free, but a very affordable way to get up to speed on popular software packages such as Microsoft Excel.